Imagine owning just a handful of stocks that quietly pay you for the rest of your life. Not because you got lucky, but because you understood the business so well, it felt like you were already inside the boardroom. That's the world Philip Fisher opens up in Common Stocks and Uncommon Profits. And by the end of this summary, you'll never look at a stock ticker the same way again. Let's dive in. If you've ever felt overwhelmed by the stock market, you're not alone. Charts, ratios, hot tips, market crashes, most people bounce between fear and FOMO, buying whatever is popular, then selling when they get nervous. They treat stocks like lottery tickets. Philip Fisher saw it differently. Back in the 1950s, when most investors focused on balance sheets and dividend yields, Fisher quietly built a completely different approach. He didn't just buy cheap stocks. He bought great businesses, and then he held them for years, sometimes for decades. This book, Common Stocks and Uncommon Profits, is his playbook. In this audio-style summary, we'll walk through why most investors stay average and how Fisher breaks that pattern. What makes a truly exceptional growth stock? Fisher's famous 15 points for judging a company's quality. The scuttlebutt method, how to investigate a company in the real world. When to buy, when to hold, and the rare times you should sell. How to use patience and focus as your real superpowers. So sit back, relax, and imagine you're listening to an experienced mentor who's seen every market mood swing and still believes in the power of a few carefully chosen, truly outstanding businesses. First, let's flip the usual script. Most people think price first. Fisher thinks business first. If you ask the average investor, why did you buy that stock? You'll hear things like, it went down a lot, or my friend recommended it, or I saw a YouTube video about it. Fisher would ask totally different questions. He'd ask, what problem does this company solve? How fast is it growing its sales and profits? Is management honest and competent? Can this business still be much larger 10 years from now? For Fisher, a share of stock is not a piece of paper. It's a slice of a real business. So imagine this. You're thinking of buying a local coffee shop. You wouldn't ask, is the shop cheap compared to last year's price? Instead, you'd want to know, are customers lining up every morning? Does the owner care about quality? Do employees stick around, or is there constant turnover? Are there opportunities to open more locations? Only after you understand the business would you talk about the price. Fisher wants you to treat every stock like that coffee shop. Before you buy a share, ask, is this a business I'd be proud to own a piece of? Now, what kind of businesses did Fisher love most? He loved growth companies, not just any growth story hyped on TV, but real businesses with long runways, companies that can grow sales year after year. Companies that keep expanding profit margins over time. Companies that reinvest in themselves, research, product development, customer experience. Companies that still have enormous room to grow in their markets. For Fisher, the holy grail was simple. A company that can take your money and reinvest it at high returns again and again for a very long time. That's how you get uncommon profits from very common stocks. You don't need 100 names in your portfolio. You just need a few that can compound quietly over many years. So how do you recognize these rare businesses? This is where Fisher's famous 15 points come in. He built a checklist, not just about numbers, but about people, culture, and strategy. We won't recite every point exactly as in the book, but we'll group them into the big ideas he cared about most. Think of this as Fisher's X-ray for any company. The first big area, growth of sales and room to keep growing. Fisher asks, does this company have products or services with strong long-term demand? Is it in an industry that still has space to expand? Is management actively looking for new markets, new products, new ways to grow? He doesn't want a business that is already peaked. He wants one that still has a long runway. Imagine a company that sells a product you see more and more every year. It's opening in new cities, launching new offerings, entering new countries. That's the kind of growth Fisher's hunting for, Not just a one-year spike, but a long series of years where sales can keep marching upward. Next, he looks at profit margins. Sales growth is good, but profit growth is better. Fisher wants to know, are margins healthy? Is the company doing anything to protect or improve those margins? Is management obsessed with efficiency, innovation, and productivity? A company that grows sales but never improves margins is like a runner who keeps sprinting but never learns to breathe better. Fisher wants companies that learn to run smarter, not just faster. Then comes one of his favorite areas, research and development, innovation. Fisher believed that great growth companies don't just ride the wave, they create the next wave. So he asks, does the company invest seriously in R&D? Are they launching new products and improving old ones? Are they ahead of competitors or constantly reacting to them? Think of the companies you admire today, the ones that keep surprising you with new features, new devices, new experiences. Fisher's mindset is the same. He wants businesses that never stop improving. Another crucial area, sales organization and marketing. You can have the best product in the world. If you can't sell it, it doesn't matter. Fisher pays close attention to, does the company have a strong sales force? Do they understand their customers deeply? Are they building long-term relationships, not just chasing quick wins? Is their marketing thoughtful and strategic or noisy and desperate? He wants companies that know how to win customers and keep them. Now we move into what might be the heart of Fisher's approach, management quality and integrity. To him, this can make or break an investment. He asks questions like, is management honest with shareholders? Do they admit mistakes or do they hide them? Are they focused on the long term or just on the next quarter's earnings? Do they treat employees fairly? Are they responsible with capital or reckless with acquisitions and projects? Fisher would rather own a good business with excellent management than a great business with shady or short-sighted management. Why? Because over decades, people in charge make thousands of decisions with your money. If those people are honest, intelligent, and long-term oriented, your odds of success increase dramatically. Fisher also digs into employee relationships and company culture. He wants to know, is this a place where talented people want to work? Is there low turnover among key employees? Do workers feel respected and heard? Are there internal opportunities for growth? Why does this matter? Because a healthy culture is a competitive advantage. Happy, motivated employees create better products, better service, and better execution. You may not see culture written on the income statement, but over a decade, it shows up in the numbers. He also cares about accounting practices. He asks, are the numbers conservative and straightforward? Or is management always playing games, changing assumptions, using one-time adjustments, making things look prettier than they are? Fisher wants clean, honest financial reporting. If management is willing to fudge the small things, they might fudge the big things too. All of these points, growth, margins, innovation, sales strength, management quality, culture, accounting, combine into one big question. Is this company built for the long term? If the answer is yes, then it might belong on Fisher's very short list of candidates. But he doesn't stop at reading reports or listening to conference calls. This is where Fisher becomes truly unique. Enter his famous scuttlebutt method. The word sounds old-fashioned, but the idea is powerful. Scuttlebutt simply means real-world research. Instead of trusting only what the company says about itself, Fisher goes out and asks everyone around the company. Customers, suppliers, competitors, former employees, industry experts. He wants to know, what do people who deal with this business every day really think? Do suppliers say the company pays on time and treats them fairly? Do customers say the products are reliable and worth the price? Do competitors secretly respect this company or laugh at it? That's scuttlebutt. Imagine you're considering investing in a company that makes specialized software. The annual report says everything is wonderful. Management sounds confident on earnings calls. The stock price has been climbing. Fisher would say, don't stop there. You might Talk to someone in IT who uses the software at their job. Ask a consultant which vendors clients love and which ones they dread. Read reviews from actual users. Check LinkedIn to see if employees stay for years or leave quickly. See what former employees mention about culture and direction. In Fisher's world, every conversation is a data point. He's like a detective, building a picture of the company that's richer than any spreadsheet. And here's the beauty. You don't need to be a Wall Street insider to do a version of this today. You have the internet. You have reviews, forums, interviews, LinkedIn, Glassdoor, industry podcasts, YouTube channels. If you're curious and patient, you can get a feel for a company that goes far beyond its stock ticker. That's Fisher's gift. He teaches you how to think like an investigative owner, not a passive trader. So let's say you've done your homework. You've found a company that has strong and growing sales, enjoys healthy margins and is working to improve them, invests heavily in research and innovation, has a powerful sales organization and loyal customers, is run by honest, long-term minded management, treats employees well and has a strong culture, uses straightforward accounting, and passes the real-world scuttlebutt test. Now comes the next question. When do you buy? Fisher's answer might surprise you. He isn't obsessed with perfect timing. He doesn't think you'll magically catch the lowest possible price. Instead, he cares that the company's long-term prospects are excellent. The current price is reasonable compared to those prospects. If he finds a truly outstanding business, he's willing to pay a fair price today because he expects many years of growth ahead. To him, it's better to buy a great company at a fair price than a mediocre company at a cheap price. A big part of his strategy is building a position slowly. He might buy a portion now, watch the company's progress, and add more over time as he gains confidence. He doesn't rush. He lets understanding compound before capital does. Now, perhaps the most famous part of Fisher's philosophy. When do you sell? He believed that once you've found an exceptional company, you should almost never sell it. He gives essentially three main reasons to sell. First, if you realize you made a fundamental mistake, maybe your scuttlebutt was wrong. Maybe you misunderstood the business. Maybe new information reveals that management isn't as honest or capable as you thought. If the original reasons you bought the stock are no longer true, sell and move on. Second, if the company's long-term prospects have seriously deteriorated, not just a bad quarter, not just a recession, but something structural. A competitor has clearly taken the lead. The industry is shrinking with no clear path to reinvention. Innovation has stalled and management seems lost. If the future has changed for the worse in a deep and lasting way, Fisher says you may need to sell. Third, if you find a dramatically better opportunity and need the capital, this is rare, because truly outstanding companies are hard to find. But if you see one that clearly outshines what you own, and you've done the work, then reallocation can make sense. Notice what's missing from this list. The stock went up a lot. I'm nervous about the market. People on TV say a crash is coming. Fisher doesn't sell just because the price is higher. He sells when the business case has changed. If the company is still excellent and the long-term story is intact, he holds and holds and lets compounding do the heavy lifting. Another key piece of Fisher's approach is his view on diversification. In modern finance, we're told, don't put all your eggs in one basket. That's wise, up to a point. Fisher agrees you shouldn't bet everything on one stock. But he also warns against spreading yourself so thin you can't really understand what you own. He believed that owning a small number of carefully chosen, deeply understood companies can be far more powerful than owning 50 or 100 names you barely follow. He suggests that many investors might be better off with something like 10 to 12 truly outstanding companies, each one researched deeply, each one held for the long term. The goal is not maximum variety. The goal is maximum quality and conviction. If you treat every investment like a business you personally own, You won't want 100-week relationships. You'll want a handful of very strong ones. At this point, you might be thinking, okay, this sounds great in theory, but what about the emotional side, the stress, the headlines? Fisher doesn't ignore the psychological game. In fact, he knows that your mind can be your biggest enemy. Markets will always swing between optimism and fear. There will always be booms and busts, hot sectors and cold ones, moments where your stocks look brilliant, moments where you question everything. Fisher's answer is to anchor yourself in understanding. If you've done the scuttlebutt, if you know the business deeply, if you trust the management and the long-term prospects, then the daily price moves become less powerful. Instead of asking, why is the stock down today? You'll ask, has anything truly changed about the business? Most of the time, the answer will be no. And in those moments, Fisher would say, the market is just offering you a different price for the exact same business. You don't need to react to every mood swing. This is how patience and knowledge become your edge. Let's bring all of this together in a practical way. Imagine you want to apply Fisher's ideas in your own life. Here's what that could look like. First, you make a short list of companies you already admire, ones whose products you actually use, whose services you see in action, whose reputation you've heard about from real people. Then, for each company, you ask, are sales growing consistently over several years? Are profit margins healthy and improving? Are they investing in innovation and staying ahead of competitors? Do they treat employees and customers well? Do they communicate honestly with shareholders? Do they seem focused on building value over the next decade, not just the next quarter? Next, you do a modern version of scuttlebutt. Read customer reviews, not just the stars, but the actual comments. Look at what former employees say about the culture. Listen to interviews with executives. See how the company is talked about in its industry. Check if people you respect in that field take the company seriously. As you do this, you're not looking for perfection. You're looking for patterns. Patterns of integrity. Patterns of innovation. Patterns of long-term thinking. If a company checks these boxes, it might be a candidate for your Fisher-style portfolio. Then, you decide on a reasonable price range where you'd be comfortable owning it for a long time. You don't wait for the absolute bottom. You understand that your real profit will come from years of growth, not from calling the exact day the stock was cheapest. You buy a partial position. You keep learning. You add gradually as your conviction increases. And most importantly, you hold through the noise as long as the business story stays intact. That's the spirit of common stocks and uncommon profits. It's not a get-rich-quick strategy. It's not about predicting the next 15-minute move in the market. It's about thinking like a business owner, doing deeper research than the average investor, focusing on a few truly exceptional companies, letting time and compounding work in your favor. Fisher's core message is simple, but powerful. Uncommon profits come from uncommon thinking. Most people never go beyond the headline numbers. They never talk to customers, suppliers, or employees. They never really study management's character. They trade symbols, not businesses. If you're willing to do a little more, to dig a little deeper, you don't need to be a genius. You just need patience, curiosity, and discipline. As we wrap up this summary, take a moment and imagine this. 10 years from now, you look back on today. You didn't chase every hot stock. You didn't panic at every correction. Instead, you focused on understanding a few great businesses, you built positions carefully, and you let time do its quiet work. That's the future Philip Fisher is inviting you into. So here's my challenge to you. Think of one company you own or want to own and run it through Fisher's lens. Ask, do I really understand how this business makes money? Do I trust the people running it? Is there a long runway for growth ahead? What would customers, suppliers, and employees say if I asked them? Would I be happy to still own this 10 years from now? If the answers are unclear, maybe it's time to dig deeper. If the answers are strong, maybe you've found the kind of company Fisher would have loved. If this breakdown of common stocks and uncommon profits gave you a new way to look at investing, I'd love to hear from you. What company are you thinking about differently now? What's one Fisher-style question you're going to ask before your next investment? Share your thoughts in the comments. Drop the name of a company you want to analyze through this lens, and tell me which classic investing book you'd like to hear next. If you found value here, consider supporting the channel with a like, a share, or a subscribe, so we can keep turning legendary investing books into simple, human, audiobook-style guides. Until next time, invest like an owner, think in decades, and let uncommon thinking lead you to uncommon profits.